Welcome back to our series on the U.S. and French tax systems. If you're living, working, or running a business between both countries, there's one concept you need to understand early: double taxation, and how to avoid it. Because without proper planning, you could end up being taxed by both countries on the same income. Let's unpack how it works, and what you can do about it. Double taxation happens when two countries both claim taxing rights over the same income. For example, a French resident earning income from a U.S. company, or a U.S. citizen running a business in France. Without safeguards, both tax authorities might claim a share of the same income. And it gets more complicated. The income could be taxed in one country this year and in the other country the next, making it nearly impossible to apply tax credits properly. That timing mismatch means you could pay tax twice on the same earnings, simply because the income and the tax don't line up in the same year. The good news? France and the U.S. have a tax treaty designed to help prevent this. The treaty outlines which country has primary taxing rights for different types of income, like salaries, dividends, royalties, or capital gains, how to claim tax credits or exemptions for foreign taxes paid, and what determines your tax residency. But here's the catch: these protections aren't automatic. To benefit, you need to properly report your worldwide income in the country of tax residency, file the correct treaty-related forms, and in many cases, work with a tax advisor familiar with two or more tax systems, especially if your income or business spans beyond just the U.S. and France. If you skip these steps, you might miss out on credits you're entitled to or face unnecessary penalties. So, what can you do to stay ahead? Here are a few cross-border tax tips to keep in mind. Report all global income, even if it's not taxed in one country. Track tax credits for income already taxed abroad. Know your filing deadlines. They differ between countries. Watch out for the permanent establishment risk if you're running a business, and plan your entity structure ahead of time to avoid triggering tax in both places. Once you've established your entity, it's often too late to revise. For businesses especially, it's important to avoid creating a taxable presence or permanent establishment in a country unintentionally. This risk is even higher with remote or nomadic employees, whose presence abroad could trigger local tax obligations without the company realizing it. That's where legal advice and tax planning come in. It's important to work with an advisor from day one to avoid running into trouble. Let's recap. Double taxation can occur when both countries try to tax the same income. A tax treaty exists, but it only helps if you file correctly and on time. Smart planning, good documentation, and local tax expertise can help reduce risk and optimize tax liability. This needs to be done early, otherwise it may be too late to adjust your strategy. Cross-border taxes are complicated, but with the right approach, they don't have to be overwhelming. That's why we're here, to simplify what's complex and help you scale up in the U.S. When you understand the rules and use the treaty to your advantage, you can stay compliant while avoiding unnecessary tax bills. And that means more time and energy focused on growth, not paperwork. Next, we'll wrap up the series with a look at wealth, estate, and inheritance taxes, and how the long-term tax implications of each system can affect your assets and family planning. Stay with us.